name is Maria Smirnova, and I would like to thank you for tuning in to the Sprott Silver Equities class webcast. Today, I would like to discuss the merits of investing in equities that explore for and mine silver. I will begin by giving you an overview of silver as a metal, its supply-demand fundamentals, and why there are ongoing physical deficits. I will discuss how industrial applications are underpinning demand and how new and exciting industrial uses are adding to demand growth going forward. And while investor demand was tepid last year, any rebounds in investor interest will certainly drive the price higher. I will then touch on silver equities and the Sprott Silver Equities class. Equity multiples are currently very compressed, so any marginal investor dollars returning to the space will lead to expansion of the multiples and will cause a surge in stock prices. But first, a little bit about me. For those of you who do not know me, I have worked at Sprott Asset Management for almost 13 years. Eric Sprott hired me as an analyst out of MBA school to primarily analyze base metals companies, and then I transitioned to precious metals a couple of years later. I've been very fortunate to work with and learn from Eric, but I am now proud to be a part of a talented team of mining investment professionals at Sprott. Moving on to page 7. Here's the positioning of various metals in the fundamental cycle. Of all the metals in the periodic table, silver enjoys one of the most versatile landscapes, with its uses found in a wide variety of applications. Silver's unrivaled characteristics serve many industrial products, while its color makes it popular in jewelry. As a precious metal, silver serves as a store of value and can provide stability against the cycles of economic adversity. As such, factors influencing the silver market primarily range from developments in the industrial and jewelry sectors to changes in the macroeconomic sphere that affect investor sentiment. As you can see in this chart, both gold and silver are on the extreme right. This means that their supply-demand balance is tight. As I will show you later, there is a lack of discoveries, which has led to, in silver's case, declining production not being able to fully meet demand. Let's take a closer look at silver's supply-demand balance on page 8. The metal has been in fundamental deficit for a number of years, and while we do not yet have data for 2017, I expect industrial demand to continue to improve this year, or last year. Silver plays a vital role in major industry sectors that are moving towards increased electrification, such as automotive and solar. And although silver is used in small quantities in some applications, the diversity is large, and the rising volumes of applications are expected to have a positive impact on silver consumption from industrial products. Jewelry use is also expected to steadily increase in 2018, expanding consumption by 4% after a 1% rise in 2017. A sizable part of silver demand is coin demand. Now, I understand it almost halved last year as investment dollars were diverted to the general stock market and other things such as cryptocurrencies, as Bitcoin increased exponentially. I would expect that any returns to volatility in the stock market and/or disappointment by the cryptocurrencies will return the investment dollars to silver. I would like to make another note on India. Indians are famous for loving gold and silver for both their store of value and jewelry applications. Last year, the country reported a year-over-year doubling of silver imports to 183 million ounces. That represents nearly 20% of the market. On the supply side, mine supply is expected to decline, and scrap supply has already dropped significantly over the last few years. In fact, the scrap market is at 24-year lows. Finally, while governments used to be a source of marginal ounces, we have not seen government sales since 2013. So on slide 9, let's drill into the industrial side of silver demand a little more. Photovoltaics, or solar, is arguably the area where industrial silver applications are experiencing the most growth. I have spoken about solar's impressive effect on silver demand in the past, but my conviction has increased in recent times that the solar industry will continue to play an increasingly important role. The reason for this is simple. Governments around the world are striving to improve living standards for their citizens. One way to do that is to improve air quality, and growth comes from both large-scale installations and smaller installations by individual households. Estimates for solar consumption vary, but everything I read indicates that strong growth from solar is expected to continue at least through 2020. China is a shining example of a country accelerating efforts to install solar in the quest for cleaner air. Figures published by Asia-Europe Clean Energy Advisory revealed that China exceeded its 2020 installed solar capacity target 3 years ahead of schedule. Renewable energy groups are also urging the European Union to increase its current 27% renewable energy target to 35% by 2030. Other countries will only add to that demand. At present, there's no cost-effective way to recycle these panels, and so the silver is not recovered. And this is true for many applications. The amounts of silver used in any one given device or application are too small to be economically recoverable. It is also important to note that over the last several years, the total supply of scrap silver has been declining as the silver price is not high enough to incentivize recycling of jewelry or silverware. Moving on to slide 10, let's touch on other industrial applications. Last October, I attended the Silver Institute's third Silver Industrial Conference, the theme of which was silver's evolving role in science and technology. The conference had diverse representation from industrial users, financial, trade, and government organizations, refineries, and mining companies. I was impressed by both the depth of the presentations and the optimism regarding silver's future. The themes that dominated the presentations were electrification, particularly in automotive, electronics, and healthcare. In the auto industry, both electric and autonomous cars will require more electronics to run, which in turn will increase demand for silver. The systems that make modern cars safer, such as night vision and lane departure warnings, are examples of driver assistant technologies that require a highest silver content. Autonomous cars will have redundant systems, such as backup computing, power systems, and collision avoidance systems, which will also increase silver content per vehicle. One of the biggest environmental issues globally is automotive emissions, and governments around the world are tightening emissions standard. Electric vehicles represent a potentially explosive growth area. Although currently representing only 1% or less of the market, projections are for strong growth. The cars of the future will have more and more solar panels on their exteriors to add power to the network, and fast charging stations will have solar panels. Again, this will lead to growth in silver use. And finally, in healthcare, silver's antibacterial properties are finding application in various consumer industrial products, such as touchscreens, glass, and water filtration. Moving on to the supply side, on slide 11, I have some mine supply projections. In 2016, mine supply fell for the first time since 2002. And this trend is expected to continue to at least 2020. This is a consequence of producers reducing capital spending in an attempt to protect margins in the last metals price downturn, which led to fewer ounces being found and fewer mines being built. In addition, increased political risk is manifesting itself in production disruptions. An example of that occurred last year in Guatemala, where the Escobal mine that is owned by Tahoe was unexpectedly shut down, costing the market 20 million ounces a year. Cumulatively, we're expecting to lose 50 million ounces over the next 3 years, representing around 5% of global mine supply. Moving on to slide 12. So as I mentioned in the previous slide, we're seeing a big lack of discoveries of economic silver deposits. Unfortunately, I don't have a slide that captures this point visually, but we do have data on the gold side. We can see that even with increased exploration spending in the exploration boom market beginning in the early 2000s, this did not translate to significant new discoveries. I spent all of my time looking for new gold and silver projects that have the potential to become profitable mines, and I can safely say that there's an even bigger shortage of silver discoveries than gold. The silver industry as a whole has not had the resources over the last few years to put into the ground. Only now am I seeing signs of renewed exploration efforts, but these are mostly brownfields projects, and are incremental in nature, designed to extend mine lives. In other words, I would not expect to see many new mines to be discovered in the near future, reinforcing my view that we will see a drop in production going forward. On slide 13, let's turn our attention to the silver to gold price ratio. We often look at this ratio to judge where we are in the cycle. Currently, the ratio is around 80-1, while the historic average is 64-1. The last time the ratio popped over 80-1 was in February of 2016, and subsequently silver went on to rally 40%. Prior to that, in the 2008 financial crisis, the ratio hit 84-1, and silver appreciated fivefold over the next 2.5 years. The point I'm trying to make here is that every time the ratio reaches an extreme point, it does not stay there forever, and silver in fact tends to go on a significant run. Since we at Sprott are well-known gold bulls and believe that gold has entered the next bull market, combined with the fact that the gold to silver ratio tends to decline during gold bull markets, I do think that silver represents a significant investment opportunity at the present time. Turning our attention to silver equities on slide 14, this is a chart showing consensus forward-looking price-to-cash flow multiples of a basket of silver producers. As you can see, while the ratio is not at extreme lows, it is certainly at low levels at less than 10 times price-to-cash flow. In fact, the sentiment in the space is very depressed. We're approaching, if not already have reached, extreme pessimism in the sector. The market is clearly ignoring the fact that these are companies that even at currently depressed silver prices are generating free cash flows, deleveraging their balance sheets, and reinvesting profits into their businesses in the form of mine improvements and exploration. It is our job to focus on these companies with the belief that when the silver price realizes its potential, these companies will outperform. These valuations are not sustainable, and silver equities will rally significantly when silver rebounds. On slide 15, we have a summary of the Sprott Silver Equities class. Last year was a tough year with several reasons for fund underperformance. First, the fund's largest holding, Wheaton Precious Metals, which is the silver bellwether stock and represents a much larger position in the index, outperformed, and we could not increase our position to keep up. Second, the smaller, more junior companies underperformed in general, and since the fund's exposure slants towards the juniors, that hurt our performance. And finally, a couple of the names in the portfolio detracted from performance due to mine shutdowns. As I already mentioned, Tahoe had its mine shut down in Guatemala, while Hecla Mining had a work stoppage at its Lucky Friday mine in Idaho. Both of these events are temporary, but hurt performance last year. Our team at Sprott continuously looks for businesses that have management teams with successful track records. We look for companies managing their cost profiles effectively and at the same time investing into exploration. As I hope I have already made clear, exploration is the engine that drives ultimate mining success, and we're laser focused on that aspect of the business. We're therefore working hard to add names to the portfolio that we believe have strong mineral and free cash flow potential. To summarize everything we've talked about on slide 16, both gold and silver were up last year. Silver was up 6.3% and gold was up 13.5%. Not many people realize that. Despite silver's strong fundamentals, the metal underperformed gold, and we feel this was due to weaker retail investment demand, as the investment dollars were directed towards the general market, cryptocurrencies, marijuana stocks, etc. The gold to silver ratio is currently sitting at around 80-1, but historically it does not stay there long. We fully expect silver to outperform gold in the medium term, as we believe gold is in a bull market. The broad investment market sentiment ended 2016 on a high note, with optimism that Donald Trump would lead the country to be great again. The US dollar reacted strongly to the optimism and closed the year at 102. However, Trump's reforms encountered some obstacles and the market started to calm down. Despite the fact that the Fed increased rates 3 times during the year, the dollar index lost 10%. Trump's tax cut package is expected to increase the deficit by $1.5 trillion, adding to an already growing debt burden, and the infrastructure package will only add to the fiscal burden. This will make it more difficult for the Fed to keep raising interest rates, and together with increasing inflation, signs of which we're already seeing, will put pressure on real interest rates. Indeed, rising debt level is not an issue only in the United States. The Organization of Economic Cooperation and Development, or OECD, warned that developed nations are facing a significant challenge to budgets as interest rates rise. The total stock of OECD countries' sovereign debt has increased from $25 trillion in 2008, to more than $45 trillion this year. A rise in yields would mean that governments would face higher costs to refinance existing debt and issue new debt, and spend more money on unproductive uses. This all points to strong gold and silver prices as hard assets designed to preserve investor wealth. And when silver rallies, silver equities will significantly benefit and multiples will expand. Equities will outperform the bullion due to scarcity of silver mining companies. Thank you for your time.